Good morning, everybody. This is Dale Bethel, Bethel Law Corporation. Once again, we're going to have a presentation today, but our presentation is going to be focused on charitable contributions through estate planning type techniques. I have a lot of clients that ask me all the time how to do charitable contributions, how to actually do them through their estate plan, and there's actually a couple avenues. But first, those avenues, when it comes to charitable contributions, really boil down to two. One is your traditional route, which is simply giving money to a charity each year as you see fit. But then there's also the estate planning route in order to provide charitable contributions. And that really breaks down to two ways we can do it. Everybody can do a charitable contribution through their normal revocable living trusts, and we'll go through that. But you can also specialize in using charitable type trust in order to get that charitable contribution, done. So with that, let's just go into the charitable traditional approach. And what I mean by this is simply, this is something everybody knows. We're going to contribute money to a charity each year as you see fit. The only follow-up is to get a receipt and then tell your tax planner that you did it. With that, it'll just be recorded on your income tax for that year, and that's really the end of it. There are a number of charities that we work with a lot, which is what we put down here. And so bottom line is your traditional approach is what everybody normally does by simply providing a charitable contribution each year to their charity and telling their tax person that they actually did so. But outside of the traditional approach is where we get involved with estate planning. Now, estate planning always starts with everybody's normal living revocable trust. And this is something that everybody should have. If you own a house, you have a probate, you want to stay out of court, keep your family out of court, you have to have a living trust. So in that living trust, where most people usually put down, a distribution to their family, you can also put down a specific distribution to a charity or a certain percentage that goes to a charity. Now, in order to set up a living trust, it's really a two-step process. The first step, of course, is to create that trust. I always like to refer to that as getting the car. But once we have the car created, we have to put the gas in the engine to make it go. And what that simply means is, in order for the living trust to work, we have to title certain assets of yours into the name of the living trust to actually avoid, that probate. Now, the first step is the actual creation of that revocable living trust. And I always like to show this slide because it kind of breaks down exactly, how the process of creating the trust are set up. It's really getting used to, maybe three words: trustor, trustee, and beneficiary. And that's you. If you're husband and wife, that's both of you. So both of you would be the makers of your trust, and we just happen to call you a trustor. If you think about it, you're the makers of your estate, and so therefore you would make your trust. What I mean by making your estate, you're accumulating assets. Now, once you have assets accumulated, you're going to be managing them, right? Well, it's the same process with the trust. So as a trustor, the maker of the trust, you're also going to be the trustee, the manager of the trust. And oh, by the way, you, husband and wife, are the first beneficiary of your own trust. So you make it, you manage it, and you do whatever you want with it. And if you think about it, that's exactly what you're doing without a trust. We just happen to now put it in legal type language for the purpose of avoiding probate and keeping you and your family out of court. Now, the cool thing about a revocable living trust is you get to pick a successor to yourself, a successor trustee. So upon death, your successor trustee takes over, and the trust tells them exactly what to do to distribute the property. So in this case, the property would go out to your heirs, your family, naturally, or in the context of what we're talking about today, you can actually pick a charity too, so that charitable contribution goes to that charity upon your death. Now, another good thing about a revocable living trust is it not only protects your family from a probate process when you pass away, but it also protects you during your lifetime. This successor trustee that you pick, usually a son or a daughter or both, will have the ability to step in at your incompetency and also manage things at that particular point in time. So the transfer process, this is like putting the gas in the engine of the revocable living trust to make it work, is simply something that we do for you or help you in the context that once the documents are created, we want to make sure they're working, and we want to title certain assets under the name of the trust. And you'll notice off of this slide, specifically, we want all your real estate titled under the name of the trust. It actually goes under your name or both your names as trustees of the trust, so you still own it. You can still do anything you want with it. It's just that we're changing how you're owning it. So instead of maybe a joint tenant titling between the two of you, it is now successor trustees or trustees between the two of you under the name of your trust. Now, we also want money. In other words, we want stocks, bonds, mutual funds, your brokerage accounts to be titled under the name of the trust. Also, your large CDs should go under the name of the trust. So when you come in and talk to us, we'll go over what should be titled under that trust. And again, everything that's titled under the trust also is controlled by the trust. And so therefore, you can pick a charity to provide certain funds to. Now, you'll notice that if you want to get more complicated by using a charitable type trust, it's still a two-step process, just like the old revocable living trust. Now, in this charitable trust creation, we naturally have to create the trust itself, and then we have to put the gas in the engine to make it go. You are going to determine what assets you want to contribute to charity. This has nothing to do with your family in a sense. It's a separate standalone trust outside of your revocable living trust. Now, the creation process is very much the same as the revocable living trust. Both you and or your spouse can be the makers of this trust. You're going to be the trustors, and legally you're allowed to also be its manager. So you can manage the charitable trust during your lifetime. Now, you will pick a successor trustee, just like the revocable living trust. They will be able to step in at death or incompetency to manage the trust if you cannot. And then the beneficiary at this time is you during your lifetime. You will get an income stream off of this if we choose a charitable remainder type trust. If you do choose a charitable remainder type trust, the ultimate beneficiary is going to be the charity. The opposite is a charitable lead trust, where the income goes during your lifetime or the term of the trust to the charity, but at the end, the principal that's in the charitable trust goes back to the family. So really what I'm trying to mention here today is setting up a charitable type trust is just as easy and just as simple as a revocable living trust. There's nothing too special out of setting up a charitable trust as compared to a revocable living trust, except for two things. And that boils down to your charitable trust will get a federal tax ID number, because everything will be reported under that federal tax ID number to the IRS. And secondly, there is a tax return that has to be done every year on the charitable trust. The charitable trust is an irrevocable trust in the concept that it's like a corporation. Anything that's put into it is owned by that trust or that corporation. The point being that it has to have its own federal tax ID number. It's its own taxpayer. A revocable living trust, you're still the taxpayers, and we still use your Social Security numbers for any tax reporting. So the transfer process is still the same with charitable trust, just like it is for your revocable living trust. Now, we can put real estate into that charitable remainder trust, and we can put money, investments. I have a lot of clients that like putting highly appreciating real estate into the charitable trust, as you can get certain tax advantages, for doing so. Of course, people put money or investments into the charitable trust too. Now, there's two types of charitable trust. I've kind of already mentioned what they are. One is a charitable lead trust, and one is a charitable remainder trust. And believe it or not, depending on how complicated you want to get, there are various versions of charitable lead trust. There's also different versions of charitable remainder trust. We're not going to get into all the heavy complications, of all the subtle differences. That would be something to come in and talk to us about. However, today I just want to give a general overview of the two types of charitable trusts that you can actually pick and choose depending on your situation. So the first one to talk about would be your charitable lead trust. This is a situation where you as the donor contributes to the trust, and that means you're also the trustor of the trust, the one who's making the trust and contributing assets to it. And how the charitable lead trust works is that all the income that is earned off of the investment or the asset that's going into the charitable lead trust goes to the charity. But at the end of the term or the end of your life, depending on how you want to measure it, the corpus or the principal of the charitable lead trust goes back to the family. Now, you may be thinking, well, what does that really all mean? In a lot of ways, a lot of my wealthier clients will use the charitable lead trust. The Kennedy family used the charitable lead trust. Really, in a sense, what they did was, upon Jacqueline Onassis's passing, she funded 2 charitable lead trusts, where she set up both her children to be in charge of each trust. And so the children, over the term of the trust, were able to pick and choose what charities they wanted to benefit with the income. But at the end of the term of the trust, all the corpus or principal went back to the children as beneficiaries. This, in a sense, avoided estate taxes upon the death of Jacqueline Onassis, but the catch is that during the term, that income that's earned off of that trust passes through to the charity. Now, the good news is you do get a charitable deduction for all of that, and you keep the family in charge of the charitable trust. They do get to pick who they want to donate to, and in a sense, that's their job as trustee of that charitable lead trust. Okay, now the opposite of a charitable lead trust is a charitable remainder trust. So if you remember, under the charitable lead trust, you donate property to the trust, the income earned off of that property goes to charity, and the principal returns back to the family. Under a charitable remainder trust, it's just the opposite. You donate property to the charitable remainder trust, and at that point in time, you will manage it as trustee. And at the same time, the income passes to you, the family, and the end of the term of the trust, it actually passes the principal down to the charity. So in this sense, what you're doing is you're getting an upfront charitable deduction based on the full value of the property going into the charitable remainder trust immediately on your tax returns. You will get the income earned off of it for life of the maker, which is you, the donor of the trust, or you can set it up for 20 years at maximum at that point. Now, this is a really good trust in the sense that you get to pick a couple variables and how you want to make it work. For example, a charitable remainder annuity trust means that you are guaranteed as the family to be getting a fixed amount of income per year, even though the investment under the charitable remainder trust doesn't make enough to pay out the income. So you can exceed the earnings of the trust each year for a payout of income, to the family. The only catch is that you better keep at least 10% of the initial contribution to the trust in the trust at the end of its term for the charity, otherwise it would be considered a sham. Now, another charitable remainder trust is what we call a charitable remainder unit trust. This is a fixed percentage of income that will come to the family every year. Now, in order to determine that fixed percentage, it has to be recalculated, the value of the charitable remainder trust each year. That may be a little bit of a hassle for some people, but what it does do is it hedges against inflation. So you've got a different amount of income that will be flowing to you every year under a charitable remainder unit trust, a different amount, whereas in a charitable remainder annuity trust, you have a fixed amount of income that does come to you. Again, under a charitable remainder unit trust, you still have to keep 10% of the principal in the trust so that at the end of the term, it's not considered a sham where it goes to the charity. Now, you may be thinking, wait a minute, it's nice for me to get some income from the asset that I'm contributing and even an upfront charitable deduction, but I'm also taking away inheritance from my family. Well, one of the strategies that we use a lot is that income stream that's coming to you, the family, you're going to use some of it to pay a premium on a life insurance policy, so that upon death of you, the principal, the donor of the property into the charitable remainder trust, will get a death benefit, and the family therefore has a replacement fund, that death benefit from that insurance policy, that replaces the principal that was donated to the charitable remainder trust. Because remember, at the end of the term under a charitable remainder trust, everything left over goes to the charity itself. So in this sense, that a life insurance policy is a really good vehicle to return the principal back to the family so that they're not out of their inheritance. The charity wins by actually getting the charitable, corpus or principal at the end of the term, and you benefit during your lifetime with the income stream and the upfront charitable deduction. So with that is a brief introduction as to how charitable trusts work. Again, you can use a traditional approach by just donating to the charity of your choice each year and telling your tax person you did so, or you can use your own revocable living trust and simply designate a distribution to a charity, either in a specific amount or as a percentage, or you can go the charitable type trust route, where you'll have a charitable remainder trust or a charitable lead trust to make your choices from. So with that, Dale Bethel Law Corporation, if you're interested to go over the details, please give us a call, and we'll be happy to sit down with you for a free consultation to discuss, the details and how it might fit within your family.